Hi, welcome to Future Focus, a financial strategies podcast where we make the complex simple. My name is Troy Branch, and I'm joined here today with my Ameritas advanced planning colleagues, Jacob Messick.
Hey, Troy.
And Nolt Nicholson.
Hey, Troy.
You got called up for another start.
Yeah, I'm excited. It must not have been too bad the first try, so I'm happy to be here.
So hopefully these are actually viewed in order, so people have any idea what we just what we're joking about. Nolt has been on. Nolt was on a previous episode where we talked about sequence of returns. By the way, if you haven't if you haven't seen that episode, as my partner Jacob would say, smash the like button and check that episode out. Okay, so in that episode we actually we started talking about sort of retirement planning. We talked about sequence of returns. Today we're going to talk about, and we talked about climbing a mountain. So again, if you want to know about climbing a mountain, just go ahead and look at that sequence of return episode. Today we're going to talk about retirement income, and we like to call it. So we climbed the mountain before. Now we're going to put together a puzzle, right? So let's put together a puzzle at the top of a mountain. Maybe we can run with that sort of analogy. So the retirement income puzzle, and we want to solve for taxes. That's what we're trying to do. The idea that we do all these things with retirement planning, and that now it becomes, how do I spend it? Like, how do I think about it? And that retirement income, like, how do I piece that together, ideally, so you can have as much income as you desire in your retirement. So so we're going to talk about that today. You guys got anything initially as I describe it and kind of what we're going to talk about?
No, I think that sounds good. I mean, I think part of it, like you said, we were talking about the mountain last time, but you just can't work on the puzzle when you're at the top of the mountain ready to take the income. You need to back up and do some planning while you're in the accumulation phase, which we talked about in the last episode. And so it's planning today for both today and tomorrow. So no, I think I'm excited because retirement planning, everyone's going to want to retire at some point. You would think.
I'm just kidding. No,
you would think most people want to plan for retirement. It may look different, may be at different stages, maybe earlier or later for other people, but most times retirement planning is something everyone is going to want to talk about or do or be prepared for.
Yep.
Any opening salvo?
So no, I agree. I'm happy to talk more about the mountain analogy and kind of tie things back and maybe putting in that puzzle when you're at base camp. It's gonna come full circle, people. But no, I'm excited.
We're going to land this plane with the puzzle and climbing a mountain and getting down. Okay, all right. So the first question I have is when you talk about building a retirement income strategy, how should people think about it? And the different ways that money is taxed?
Well, I guess first off, we probably need to say that, hey, this whole conversation here is just general information. It's not considered advice or what to do. That everyone's situation is a little bit different. As we like to talk about, it all depends on your own specifics. So just wanted to preface, hey, this is just some three guys talking, just some general information on solving that retirement puzzle.
That's perfect. Yeah, no, when I think about it in terms of we're getting ready to retire, right? And you've been hopefully shoveling some money away for that retirement date that we've all been looking forward to. But it's a little more complicated than just putting it in one giant bucket, right? There are different kinds of buckets, and that's something I don't know if we want to get into now, but we have it.
Absolutely, because before you get into it, and I'm quite sure that you're going to have plenty to say. I'm going to just go ahead and warn everyone, like, there is no way we're getting through this episode. Actually, with our jargon jar, there's no way we're getting through this episode with, I would say we should ante up. We should probably ante up like two a piece. And if we can keep it just to two, that's we'll consider that success.
What do you mean when we talk about saving for retirement? We talk about the three buckets and taxable, tax deferred, and tax free. That's gonna have me throw one in there.
Just go ahead and get them all in. There's no way we're getting through. So we'll just put those in escrow, if you will, and then we'll figure out if we need to go above that.
Okay.
I don't see your two in there.
I'll put the other one in there as we go.
Okay. So he's up to the challenge.
I'll start with the one for those words that I use: the taxable, the tax deferred, the tax free. I'll put the one in for that, and we'll explain what those are here in a minute.
Okay. So let's go ahead and just a reminder is again, how do we think about, or how should we be thinking about the tax characteristics of accounts, or what people should be thinking about, at least initially when when they're thinking retirement income and the puzzle that it is in actual retirement.
Yeah, I guess so. So that puzzle, we like to talk, and we talk about it all the time as the retirement savings triangle, because there's really those three components, and we've kind of mentioned about it already a little bit: the tax deferred, the taxable, and the tax free. But should we hit on the taxable first?
I said let's do it.
All right. So tell everybody what a taxable account is.
So a taxable account is just what it sounds like, right? That you're paying taxes now. So the tax bill is due. So we're talking like a mutual fund or stocks, kind of just pretty generic sort of investments. And
I'll go, how about just a regular savings account?
exactly.
CDs, money
CDs,
market accounts. I would say
yeah.
savings or investments outside of your typical retirement plan, your qualified retirement plans.
Okay, go ahead. No, I'm sorry.
No, exactly. And I think the conversation really comes down to, one, are you paying taxes? And if you are, when?
Right.
And that's really what you're kind of splitting these buckets apart, looking at those differences and trying to dive deeper into, well, how should I put money into one bucket versus the other? And so taxable is pretty straightforward. You're paying the taxes basically now, but there are other ones like tax deferred and tax free, like you mentioned.
So talk about tax deferred. You want to talk about tax deferred?
Yeah, I can hit on that. So, those are examples of those. The most common ones you see are traditional IRAs, 401ks, 403bs, those qualified retirement plan vehicles that you may see through your employer, and typically.
So we have a thing called the jargon jar.
Yeah.
And you said
felt like those-
qualified retirement plan.
You got there.
All right, we'll throw one in there. We'll throw it in there for
All
that.
right, here we go.
So what all that means is you are funding these accounts with typically a lot of times with pre-tax dollars. Now, depending on your income and but a lot of times it's
I'm just going to let you finish. Go.
a lot of times you're
Just go
using
ahead.
pre-tax dollars to fund these accounts, and these dollars are growing tax deferred, so you are paying the tax on the back end. When you're taking out the income in retirement, those withdrawals in retirement becomes taxable at that point. So you're deferring the taxes, you're getting the tax deduction potentially now, but you're paying the taxes down the road, at a later date, typically in retirement.
Right.
Yep, exactly. And that's the focus, that you're paying the tax man. It's just you're doing it later down the road, and there's some calculation in there, how much should I put into that bucket? Depends a lot on what those tax rates are, and we can get into that later on. But
it's more than I mean, yes, it is about like when you pay the tax man, but there's some advantage between taxable and tax deferred. Like speak to the, I don't know if I know we've seen it because we talk about this stuff all the time, and I think most people, I don't know how many people have actually put a taxable account where you're paying the tax. The way I think about it is you're paying the tax every year, right? The tax man is there every year versus the tax deferred account where, if people think about their 401ks and maybe traditional IRAs where they're getting they're not paying tax now in the form of a tax deduction, right? That income doesn't count. But also the key difference there is I'm not paying it as it grows. So when we think taxable and tax deferred, how would you explain that difference probably better than I just did?
no, I think it's a great point, because you're correct. It's not just the timing of when you're paying the taxes. It's that you haven't paid taxes through that process. And so you have a larger bucket that has hopefully grown more as time goes on. So when the time does come where the IRS or whatever taxing authority comes and says, hey, you owe us some money, hopefully it's a larger bucket that you've built up because of that deferral. And so that's a really simple way of kind of talking about that element along with the timing element later on. And I don't know if you have anything else to add to that.
I think to me it really goes to, we may be touching on this later in this episode, but it goes towards flexibility. Taxable, typically you can potentially access those funds a lot of times before retirement or before age 59 and a half. And I'm just going to throw that in there. Why 59 and a half is important? Because let's say, qualified funds like IRA, 401k, you access those funds before age 59 and a half, unless an exception applies. There's an extra 10% tax penalty on accessing those dollars early before 59 and a half. Unless, like I said, unless one of those exceptions apply, and we can always touch on those later on in the episode. So, the taxable account gives you flexibility where you can access funds. You still have to pay taxes, but you don't have that extra penalty that you have to be cognitive of and be aware of and manage of. So it's utilizing those two together as part of working on that puzzle for retirement.
Going back to your original when we talked about climbing the mountain with the puzzle in your back, in your backpack, it's you start to climb a lot, a long time before you get to the top.
Yeah.
Mm-hmm. And it's thinking about how does taxable and tax deferred, what's the interplay and how am I going to use both of those things, because both of them will be needed at different points along the way.
Yeah, at different point in times, you may want to utilize those different buckets, those different accounts in different manners.
Mm-hmm. So taxable, tax deferred, now tax free, and we always have to be, we always have to be careful when we talk about tax free because
it depends. It depends on the situation.
Depends on the situation.
It has to be the right scenario to access funds. Have access to funds tax-free, depending on the type of account that we're going to talk about.
Right. Let's talk about why tax-free. So taxable, tax deferred, and now we're talking tax-free. Why tax-free?
Well, as it says, hopefully that we follow the process for whatever type of account where we can access that money tax-free. Mm-hmm. It just gives you more flexibility later on. If you have a problem, let's say a sequence of returns problem, reference the previous episode, hopefully. Yeah. If you have that problem, well, now you've got a bucket of money that you can pull from instead of having to access the money that you have invested in the market where it's down potentially.
Well, I probably jumped us just a little. I probably jumped us there a little sooner. So, key difference between tax-free, like what's happening if I'm lining up a taxable, a tax deferred, and a tax-free account. Key difference with the tax-free account.
I'll take a stab at that one first, and then let you add on anything that I might have missed or say differently. So, main point are those dollars going in. We talked about the tax deferred for a lot of scenarios. Those dollars are going in pre-tax. For tax-free, like we're talking Roth IRA, Roth 401k, those dollars are after tax, like a taxable account. Mm-hmm. Those dollars are going into the account on an after-tax basis, so you've already paid tax on those contributions amounts, but then those dollars get to grow tax-free, and then as long as you're in the right situation, you're able to access those dollars in retirement without, on a tax-free basis, not having to pay taxes on the withdrawals coming out, like with the tax-deferred account where those dollars are taxable, tax-free they're not.
Right. And then?
No, that's perfect. The name describes it, and I think you nailed it perfectly.
So if I'm scoring for the folks at home, taxable is what it is, right? Taxed every year. Tax deferred, I'm not going to be taxed. I'm not going to be taxed as dollars go in, whether that be a deduction, whatever it may be. I'm not going to be taxed as the dollars goes in. Those will grow without me having to pay tax, and I pay tax on the back end. Tax free is I pay tax on the dollars going in. So in theory, it's smaller dollars going in, but I pay tax on the dollars going in. I still don't pay tax as they grow, and then I get to pull them out tax free without having to pay income tax.
You got it.
That fair enough if we're scoring at home and people are sort of trying to put it on a grid. Okay, so let's move on. Most of the people that we talk to, whether it's a qualified plan, whether it's a tax deferred plan, i.e. qualified plan, whether it's whether it's even a tax-free account that like a Roth IRA or a Roth 401k. most people spend their time thinking like, I want to defer taxes, right? Because we know that if we put a taxable account and a tax deferred account, you're going to have a bigger bucket with the tax deferred account. And we can argue about tax deferred and a tax free account, but you're going to have a bigger bucket if you don't pay tax as the money grows. So people spend a lot of their lives thinking about deferring taxes. But should that be the end goal? And if not, what should be the end goal?
So I would say no, that shouldn't be the end goal. And part of it is, especially when you're talking those tax deferred accounts, we're making a pretty large assumption in that we think the tax rates are going to be roughly the same or potentially lower for you when you pay those taxes, right? Because by its nature, you're saying, I'm not going to pay taxes today, I'm going to pay it later, right? Mm-hmm. What happens if that calculation is wrong and taxes are higher? Does that still make sense to have money in that tax deferred bucket? Does it make sense to have as much as you have in there? So I think part of this discussion is we follow tax changes pretty regularly as part of our job. I mean, as we're filming this right now, I mean, when we leave the room, we might have a new tax law that we're trying to digest and understand. So I can't tell you what the taxes are going to be in a year, let alone 20 to 30 years from now. And so part of this conversation, especially with the tax deferred accounts, is knowing that we might want to have some flexibility in the overall plan because we don't really know what that variable is going to be when retirement comes. And so that's when I'm thinking about these accounts and kind of how they relate to each other. That's a big variable we really need to pay attention to.
Right.
No, I would agree. I think, like you said, it's all about flexibility. It's a balancing act, trying to make sure that you're not overly weighting one bucket over the other, because like you said, we don't know. I mean, you may know what your tax situation is now, but you don't know what it's going to be down the road. It could be higher, it could be lower. But I think that's where it goes with constantly, reviewing your situation. As we've talked about, planning as a whole, it's always monitoring the situation. It's not a set it and forget it. It's review it along the way in regular intervals when life changes occur, to be able to monitor to see what makes the most sense, because it makes a lot of sense to have funds in all three different buckets so that you have the flexibility, you have the control to balance out those needs as you get closer to retirement.
So what you guys are saying, like what I'm hearing and what I refer to it as tax diversification, mm-hmm. right? Like, and that's going to afford you the flexibility that we always talk about having. It depends. Like we joke about it, but it really being able to say it depends. And here's why you want to have, you again, to piece the puzzle together as we're climbing. I'm going to make this thing work.
You're landing it.
I'm going to make and climbing this mountain with a puzzle on your back, so I can complete the puzzle at the top of the mountain as I'm going down. Anyway, I'm going to make it work. But no, the idea of tax diversification lends to that flexibility that you're talking about. Now, with that being said, I know what now this is a personal, editor. This is an editor's comment from me personally, I should say. I know a lot of people like really get excited about the idea of tax-free income, largely because of what you just described. I don't know what the tax rates are, and people will have a feeling that they're going to be higher, that they're going, whatever. People will have a feeling about whether or not, where they believe tax rates are going to go. But people really seem to love. I know this is me. Like this is Troy Branch. This isn't, general. And I'm not making a recommendation, just in case you're wondering. I really enjoy the idea of tax-free income. And I think a lot of people fall into that category. What do you say for those folks of like why do I feel that way? Tell America why I really love tax-free income.
Well, I mean, I think as a general matter, most people don't like paying taxes, but it's not an enjoyable feeling that most have. But I think it's just the idea of having something that you have more control over, or kind of that feeling of control when you get to retirement or earlier, that you've got something there that you know what it is, you know how it's taxed. It's not this archaic, rule about when I can access it or how always. So I think it's one of those things that people they like having that control element and a little more flexibility in their overall plan.
Here, I'll give you an example, and we talk about this one a lot, so this one will make you smile. So, Troy, let's say you're getting ready to retire, and we'll just, to keep numbers simple, let's say you want to take $1 out in retirement. Tax-free is so powerful because if you want $1 in retirement from a tax-free account, you only have to take out $1 to get that dollar. If we were in a tax-deferred bucket and talking about tax-deferred dollars, you're going to have to pay tax on that dollar. So the example that I had written down here, so let's just say you're in a 20% tax bracket. Keep the numbers nice and simple. 20% tax bracket. Tax-free bucket, I want $1, I take out $1, I keep $1. The tax-deferred bucket, you take out $1, you're in a 20% tax bracket, you only get to keep 80 cents. Well, you want a full dollar. You want to take out $1, you want that full dollar, you're going to have to take out more than $1. You're going to have to take out $1.25 so that after tax, after that 20% tax rate, you get $1. So that, to me, that's the value of the tax-free income. I want $1, I only have to take out $1. I don't get less, I don't get 80 cents, and I don't have to take out more. I don't have to take out $1.25.
Right. And so, yeah, I love tax-free income. So you did a really good job there. But it's not all tax-free income or bust, right?
No, I think it's. I always talked about it. I think it's a balancing act. It's you need to have, I should say for a lot of people, it's having funds in all three buckets, so you have that flexibility and that balance. If you're wanting to retire before 59 and a half, or you want more flexibility and access to funds, having funds in a taxable account makes a lot of sense. If you are in a high tax bracket now, maybe it makes sense funding, a tax deferred bucket like your 401k to get that larger tax deduction now, where if you're in a higher tax bracket now compared to retirement, that may make sense. So to me, it's a balancing act.
Exactly. It's all about building in that flexibility, right? That, like you're saying, maybe your tax rate now is really high, but at retirement, it's going to be extremely low. Well, maybe it makes more sense to have more in that tax deferred bucket for you. But just having all of these buckets and understanding what they do and what they can accomplish is really the key. And each person's going to be different. It's not a one size fits all scenario. So no, I think that's perfect.
America's not always depends. Excuse me, I shouldn't say it's not always, but it actually is always. It depends.
It's going to look a little different for you than it does for me, than it does for Noel. It's not a one size fits all. Not everything's going to look the same in retirement, and that's where starting that planning. If you haven't planned, if you haven't already started planning, planning now. The sooner you plan, the more flexibility and control you have over your situation.
So now we've talked about the buckets. We've talked about why, at least I'm ecstatic about sort of tax-free income. And we talked about it still depends, right? There's reasons to have it in those, in those different buckets. So talk about some of the other maybe vehicles that can fit in that tax-free bucket that people might not readily think about. And most people think about Roth, right? Like if you put Roth in front of it, that has a certain connotation. People get, I'm going to pay tax now. It's going to grow without me having to pay tax, and I'm going to get my money out tax-free. So people hear Roth. So Roth IRA, Roth 401k, people can kind of figure that out. What are some other things that, when we think about tax-free income that people should be thinking about as part of an overall when they're piecing the puzzle together?
I would say health savings accounts are one that come to mind, that if you have qualifying health expenses, you could use that potentially as a tax-free bucket of money,
For health expenses.
For health expenses
For health
specifically.
expenses.
Correct. Exactly.
Yeah.
And so that's something that, we see a lot of people that will use that as a vehicle, or maybe they don't have a lot of health expenses, but they're able to save into that account. Or maybe they have enough money off to the side that they pay the health expenses and just kind of hold on to the receipts for those health savings accounts. And then they get to retirement and they basically go and say, well, I'm going to reimburse myself for this medical expense I had 10 years ago, and here's the receipt. So a health savings account can be a great vehicle that's going to be tax-free, again, for those health-specific expenses that you might have. We also talk about other ones like, I don't know if you want to discuss, Jacob.
Yeah, I mean, one of them that comes to mind a lot, especially from the investment side, is municipal bonds. Interest that comes from municipal bonds are generally tax-free at the federal level, can potentially also be tax-free at the state level. And so that's just also another valuable source of tax-free income, especially for those individuals that may be in a high tax bracket. So that's another one that we see get used quite a bit as well.
Right. But talk about the idea of permanent life insurance as a vehicle that could give you access to tax-free cash or tax-free income.
Yeah. So there's certain types of permanent life insurance, and you may hear the words whole life insurance or universal life or index universal life, variable universal life, a lot of different names for different types of permanent life insurance. But we're just going to say permanent life insurance as a whole, depending on how it's being funded, has a cash value component in that. And and you have access to that cash value through loans or withdrawals to basis, as long as the policy is not a MEC. Now,
I'll just go ahead and move that, because I just realized that the people might not be able to see that we're putting it in jargon.
I'm throwing that in there for my saying the word or saying the abbreviation of MEC, but
I'll tell you what, you got the one for the abbreviation. I'll actually take the hit for actually saying what the abbreviation is. Okay. And then we can go ahead and then you can keep talking about permanent life insurance. So a modified endowment, MEC is an acronym for a modified endowment contract. That's not something that we came up with. That's what the tax code calls it. So I give it back to you.
And what's that? That's just too many dollars are going into a life. And so permanent life insurance, you can only put a certain amount of premium dollars in there to keep it from becoming a MEC. If it becomes a MEC, you lose some of the tax advantages, that tax-free access through loans and withdrawals. It becomes, you get taxed on the interest coming out first. So as long as the policy is not a modified endowment contract, not a MEC, you have the ability to access the cash value on a tax-free basis.
Exactly. Yeah. And those are kind of the primary tax-free buckets that we think of. Talk life insurance a lot, obviously being a part of a life insurance company, right. But there are a lot of other viable options.
But I would say, we talk about life insurance, permanent life insurance in this case, as another tool in that, in that retirement income toolbox, along with sort of the things that most people think about life insurance, about the death benefit. There's a bunch of other things, benefits, if you will, that permanent life insurance has. But we still talk about it in terms of a death, in terms of a death benefit. But in this case, when we talk about retirement income and it being the puzzle that requires a taxable bucket, a tax-deferred bucket, and a tax-free bucket, we also can talk about permanent life insurance in that respect as well. So I think, of course you talk about permanent life insurance, you work for a life insurance company, but we also have the advantage of talking about subjects, well beyond just the idea of life insurance. And in this case, permanent life insurance still fits, even when the subject is retirement income, the puzzle that it is, how do I solve it? All right. So I hopefully that goes back to, it depends, right?
Yep.
It's not for everyone, but it can be for, but it can be for someone.
But for the right situation, the right case, it could work, it could fit. And I think that's just the value of having dollars in all three components as you're looking to manage how you want your retirement to look.
Exactly.
All right. I think we want to stop there. We're going to come back to part two. I want to thank everyone for your attendance in part one. Hopefully you've got a good understanding. When we come back in part two, we want to talk a little bit more about application, sort of the art form that is the retirement income puzzle, and piecing that together. Again, I'm Troy Branch with Future Focus, the Financial Strategies Podcast. We'll see you in part two.